Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This is for Friday, ending December 16th, getting ready for the open on Monday, the 19th. Today we have two reports for you. The S&P 500 Condor Butterfly Timing Report, for those of you that like to sell premium from a market neutral standpoint. And then we have the S&P 500 Directional Likelihood Report, for those of you more statistically oriented toward the markets. If you want to subscribe, please click on the button below. And also we have a free ebook for those of you that want to click on the link above and get this a free book, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Here's the current condition before we get to the reports. We have an inside bar that occurred yesterday on Friday. We're above the 50-day simple moving average. The stochastic is between 50 and 99, yet it is below the moving average. This is a very unique condition. It's occurred about 130 times between January 2000 and now. And so we're going to take a look at these reports in light of this current market condition, an inside bar above the 50-day simple moving average with the declining stochastic between 50 and 99, okay? Now, for an overview of the reports, many of you have already watched these reports enough to know all the all the details of what goes into this. So let's just go over the results of the report, and then for those of you newer, we'll get into get into the weeds. So we can see here that we have a selling edge of 9.1. What does that mean? Well, since January of 2000. There have been over 4,200 daily closes of the SPX, okay, about 4,266. Of these 4,266, 65% have been favorable bars for selling premium where the actual 21 bar movement was less than the SKEW adjusted implied movement. Okay, so that's the benchmark is 65. Also during that time, the current condition detailed below, what I just showed you, has occurred 139 times. Of those 139, 74.1 of those bars were similarly favorable for selling premium. That implies an edge of 9.1%, 74.1 minus the benchmark of 65. Okay? So that's where we're at. We have an edge currently. Let's go to the likelihood report. Then we'll get into the weeds on both these reports. Lots of negative numbers here, meaning this is a picture of a lower market volatility than normal of the six bands. Okay, the three upper bands and the three lower bands, all six were hit less often in all three scenarios that we describe, and so that's the picture we have. Using SKEW adjusted VIX for the band locations, almost all the categories have lower numbers, indicating lower than normal market volatility. Okay, so that's where the reports are. Let's get right to it. Let's go to the timing report, Butterfly Condor timing report. Why would you look at this? Okay, we're going to look at why, we're going to look at the methodology, and then we'll look at the current market condition and the edge level in detail. Back on December 31st of last year, the market had begun to channel, but had you gone through the algorithms that we have, we would have discovered that there was a negative edge to selling premium neutrally here. Butters and Condors, a negative edge. What did that mean? That there at the time, there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. Okay, there was a negative edge, and indeed the market did go on a tear, in that case, to the downside. A cherry-picked example, to be sure, but just to make the point that just because you have a channeling market doesn't necessarily mean that it's going to continue. Here's the current condition. The question here is this current condition a good one for selling option premium through range trading, Butters and Condors? Here's how we do this. We look at actual volatility and understand it. We're going to understand the implied move Then we're going to compare the two in retrospect and label bars favorable or unfavorable. Okay, so let's go and look at the methodology of looking at actual volatility or actual moves. So we have a close here. We go forward 21 bars and we ask ourselves, how far did the market move to the max, either downside or upside? Well, here it moved 50 points. That's that's the highest level it moved. That's the actual move, the actual max move that we saw. 50 points turned out to be 2.4%. Now, what market move was being implied by the option prices at that time? This is key in terms of figuring out if now is a good time to sell premium. We have to understand the implied move and the actual move. The actual move is 2.4. What was being implied was a 4.4. We took the 21-day SKEW adjusted VIX. Okay, it turned out to be an implied move of 4.4%, which was higher than what actually took place. That was then therefore a favorable bar for selling option premium through Butters and Condors. You would have sold it for a higher implied volatility from the option prices than what actually occurred. So we're going to paint all those same types of bars blue and label them favorable. And then we're going to label the bars that were opposite red, unfavorable, where the actual moving forward was higher than what was being implied at the time. All right, so that's our framework. We're going to ask ourselves historically, what percentage of all the bars are favorable? Then, and that's our benchmark, then we look at only those bars that match our current condition, and historically, how many of those were favorable or unfavorable? If there's a big difference, that represents the edge. Okay, so historically going back 4,266 bars, 65.1% of those bars turned out to be favorable. That's our benchmark. 34.9 were unfavorable for selling premium. Now, of the bars that match our current condition, 139 of them or so, what percentage of those were favorable? 74.1. Okay, 74.1 minus the 65. Okay, a little rounding thing, makes for a timing edge of about 9%, meaning that there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. Okay. All right, so there's your edge. We just described it in detail. That's the condition we're in, a very unique condition, inside bar, under those above the moving average in a declining stochastic. Very unique, but there's apparently historically an edge to selling premium neutrally there. Now, before we get to the other report, make sure you understand Discover Options has a great one-on-one mentoring program. Okay, wherever you are in your options trading, we can help you take it to the more advanced levels, even to the levels of an advanced money manager. We have a lot of money managers that come to us for assistance in understanding risk management and understanding adjustment approaches, etc. And we have a great curriculum. We'll custom create a great curriculum for you to get you to where you want to go. Go to our website, check it out, look at the curriculum, call us up, speak to one of the reps. We'd love to help you. Okay, here is our next report, the likelihood report. Again, we have our current condition. Here's the question on the table. Since Jan of 2000, how often has this same condition occurred? And what did the market do in terms of direction and volatility? Okay, we're going to go back. We're going to look at all 139 of those. And you know what? If every time the market went up, well, we're going to be very curious about that and explore it and perhaps go, take a long position. Okay, maybe it turned downward a whole bunch of the times. So we're going to go take a look, and we have to figure out exactly how we're going to measure all of this. So here's what we do. We do this in terms of historical distribution of price. We're going to understand the distribution of price going back for all 4,266 of closes going back to Jan of 2000. Then we're going to understand the price distribution after our market condition developed, and we're going to compare the two. Okay? Now, what's historical distribution of price? How do we determine that? We do this using volatility bands. We use 3 sets of bands to the upside, 5, 10, and 15 days. And then 3 sets to the downside, 5, 10, and 15 days. The width of the bands is determined by a 20-day historical volatility. I'm going to switch that up after I show you this first one. It's like normally distributed. All right, so let's just look at an example quick. Here's a 10-day band. 10-day bands. Go forward 10 days, forward 10 days. Question on the table is, in this particular, from this close, did price hit the upper band, the lower band, or did it wobble in the middle? Okay. In this particular case, it went up and hit the upper band. So in our database, we record that it hit the upper band for that close. Oops, timeout. Okay. Now for this close, we have 10-day band, we have a 10-day band, and then we have a then we're going to ask, did the price go up and hit the upper, the lower, or wobble in the middle? Okay, let's go take a look. Boop. And let's see if you'll notice, it certainly didn't hit this upper band. Okay, but here it is. Did it hit the lower band? Nope. Close but no cigar. Close but no cigar. So in this case, it hit neither. So in our database, we record that it hit neither band for that close. So when we determine distribution, for every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. So here's where we are, Jan of 2000 through Friday. Okay, of those 4,266, price struck the upper 5-day band 29.3% of the time. And you could just look at these percentages that it hit the respective bands. It hit the lower 15-day band 32.3% of the time. All right, so that's the distribution of price from a benchmark perspective, inclusive of several bull and bearish markets. Okay, now we're going to go and look at those 139 incidences of our current market condition and then see what it did then. We're going to look at distribution as of the close, all 139. Then of those 139, what happened if price broke the previous day's high? What was the distribution if it broke the high? What was the distribution if it broke the previous day's low? So that way, come Monday, you'll have a good idea how to trade this. Okay, so here it is. From today's close, or from Friday's close, we had 135 incidences. There were apparently 4 consecutive ones that didn't get included here. These are non-consecutive occurrences. You could see across all 6 of the bands, they struck the bands less often than the benchmark. Instead of 29.3 benchmark, price struck the upper 5-day band 25.9% of the time with our current market condition. Okay, so that's lower. That's a lower level. So this speaks to a picture of lower market volatility. Lower market volatility. Now, if it exceeds the high, it happened that way 80 times. You know, after that inside bar, it broke above the high 80 times, and in that case, you know, it failed to hit the lower 5-day band 12.3% less often. But all the others are pretty darn close to benchmark, to be honest. Very close. If it went down below the low of the inside bar, again, it also struck the bands less often across all 6 time frames, 3 upper and 3 lower. Again, a picture of lower market volatility. Okay, now I like to also cast these bands using skew adjusted VIX. VIX is typically higher than statistical, so the bands are farther out. They then get hit less often, as you can see here. See that? So in that case, what do we have now? Well, similar picture. It's a picture of lower market volatility. The bands are getting struck less often across almost all time frames, up and down, except for this lower 15-day band over here if it goes above the high. That got struck more often in that particular case. But again, overall, a picture of lower market volatility. Here are the volatility figures. Statistical volatility, last 20 days, 9.1. Skew adjusted upside VIX is at 10.3. The skew adjusted downside VIX is at 14.1. Keep that in mind as we now take a look at a suggested trade idea for you. Okay, click, click. There we go. Let's take a look at a hedged bull put spread. We love this type of position. We love it because we have some fat premium brought in from a bull put spread, and then we are taking some of that credit and buying a very, very cheap but effective hedge here, a bear put spread, where we're selling for premium, a higher IV than we're buying. Now the nice part about this is when you do a risk graph, no matter how much the market goes up, we're going to make 4% as of expiration. If it goes down, we're looking at making 4 times that, about 16%. So if it does go down and give us some consternation, well, if it closes above that one standard deviation of the downside, we at least get rewarded for that. So when you draw the profit area, then our price chart presents a very, very good picture indeed. So that's just an idea for your consideration. Thanks for joining us. I'm Steve Lentz with Discover Options, and we're going to take a few weeks off here for the New Year's and Christmas and Hanukkah and everything. So wish you a very happy holidays, and we'll see you next year. Take care. Bye-bye.